Hello, party people. Uh, just been having a few tech issues over here. If someone could please, just while we're waiting for people to come in, if someone could just pop into the chat and just let me know that slides and audio are coming through okay, that would be awesome because my Zoom is not liking me today. Great. Awesome. Thank you, guys. Uh, Great. Perfect. Cool, guys. So, look, today we're talking about how to build a second income investing. Firstly, I just want to say nice work on jumping on to the session today because I know at this time of year, it's like a lot of people are taking their foot off the pedal in the run into the end of the year, and you'd almost be forgiven for doing that. But money is a momentum game, and so it's the actions you take today and the steps that you make now that drive your results over time. And I'll talk a little bit about New Year's resolutions as we get into the content, but a lot of New Year's resolutions fail. And the reason that they fail when it comes to money is because a lot of people wait until the new year and then they're starting behind. Whereas if you can do even a little bit of stuff coming into the end of the year, then that means that you're starting stronger in the new year, and then you just keep the momentum building from there. So yeah, shout out to you guys. Also, big shout out to our event partner for today, Perla. Look, I assume that everyone knows who Perla is, but if you've been living under a rock and you're not, they're a cracking investment powerhouse, and you should definitely check out what they're doing. They are a platform for long-term investing. We collaborate. There's no kickbacks or anything like that. We just are very aligned in they talk about a boring investing for the long term. I'll talk a little bit about boring investing as we go through today, but we know that they just do great work. So definitely worth checking out if you're not already across them. Also, for the lawyers, guys, this is not advice. Please seek out advice. We encourage you to do that. If you're, making big decisions, you probably should be thinking about that stuff anyway. And guys, I'll just say, just in terms of the practicalities as we go through today, if you've got any questions, you can feel free to throw any banter into the chat box, but if you've got a question that you want to get answered, please pop it into the Q&A. That will just make sure that nothing gets missed. I'm going to do my best to answer as many questions as we can as we go through, and then we'll have time for questions at the end as well. Now, for anyone that's new to our content, and we are recording the session as well, and we'll spray that out on email afterwards as well. If we've got any first timers here, I'd love for you to say g'day in the chat as well. If you're here for the first time and you're not familiar with our content, we do a heap of different content events like this, which we've got scheduled into the new year. We've got a heap of content on our socials, Mo Money Podcast, heap of resources on the Pivot Wealth website as well. Got a bunch of first timers saying g'day. Hey, everyone. So yeah, feel free to check that out. If you're interested in this sort of stuff, there's a bunch more where that came from. And I've recently released a new book. It's called Virgin Millionaire. It covers a lot of the principles that we're going to cover off today. And essentially, it's the step-by-step guide to your first million and beyond. Importantly, it talks about the different stages that people go through with their money and what you can do to make faster progress. I've actually got a ton of first timers here today. So welcome, everyone. I can see Roman, Yolanda, Brelly Boo. I don't know if that's a real name, Brelly Boo. Sadaf, Mayank. Am I picking the hard ones to say? Ainsley. There's a heap there, guys. So welcome. Great to have you here. All right. So look, guys, I'm going to start by sharing an example. This is a person that we helped with their money a little while back. Sort of ties into the build a second income from investing theme. I'll give you the background and then talk about what they were struggling with and where we got to. So this person, mid-20s, income $120,000, just starting to bump up their income from starting to hit their straps from a career perspective. Reasonably good at savings. They had built up cash savings of 45 grand, still living at home, so costs were pretty low. Saving at around 2 grand a month, which was pretty good, but also because they were at home and costs were quite low, felt like that there was probably an opportunity to be doing a bit more than that as well. When they came to us, then they basically had no system around what they were doing with their money. They just get paid, spend a bit of money, save what was left over. never invested before, wanted to buy a property, but didn't really know how it all worked, and felt like their progress was really slow because this person was based in Sydney and they had a big goal of getting into the property market. They knew that they needed a chunk of money, and it just seemed like it was going to be forever away to actually get there. And so what we did, we put a bit of a savings plan in place to figure out what is the money that they wanted to be spending on different things and how much did that leave over for savings and investments. As a result, they ended up increasing their savings by $1,000 a month. So basically got 50% more savings. At the same time, what we did was we went through one of the tools that I'm going to share with you today around setting some targets around investing, basically showed if they were to invest some of the money that they had in savings and some of their regular savings moving forward, how that money would actually grow over time. And they invested $61,000 over the next 12 months. So part of that was from the initial, the 45 grand that they had in the bank, but keeping a bit for an emergency fund, and then their regular savings moving forward from there. Now, just the moves made in that 12-month period, by age 60, those investments would grow to be worth about $3,025,000 just based on the long-term market returns. I'm going to get into what it was in it as we go through. But $3 million would give them an income of about $150,000 a year for the rest of their life. And guys, this is just the moves just made in a 1-year period. It also put them on track to buy their first property, in a faster time frame because they were getting the money invested rather than just letting it go backwards in a savings account. And look, the overarching message is I met these people by chance off the back of an event, actually, and I am really confident that if we hadn't have had a conversation and then spoke 12 months later, they would have been in exactly the same position. And so I think a lot of people, when they think about building another income from investing, they think that you need heaps of money for you to even think about getting started, or that you need to do a lot, or it's going to be really complicated, but it doesn't need to be. And small changes now can make a big, big difference over time. And this is why it's so important to get started. So as we're going through today, what I want to give you is the building blocks for you to get started or start doing a little bit more, or a little bit being a little bit smarter with what you're doing so that you can get more out of the money that you already have. Because look, I know that it's not easy, right? That everyone wants to nail it with their money, but overall, on average across society, we're really not nailing it. And while everyone's situation is unique, there are 3 big challenges that hold people back. The first is information overload. It's like there's so many options out there, so much information. It's like they're drinking from the fire hose. It's hard to know who to listen to and who to trust. The second is that people struggle to find balance between how do you get ahead today and live a good lifestyle today, but also get ahead for the future so that you're setting up the future lifestyle that you want. And the third is the fear of missing out. But more importantly than that, the fear of making a mistake, the fear of effing it up, basically, that you don't want to do something dumb that you regret later on. And so as a result, for a lot of people, because you work hard for your money and you don't want to blow it up, these problems combine to lead people to get stuck. And often you're stuck, not stuck doing nothing, but often stuck just doing the same thing that you've been doing in the past. And what that really means is that you're missing out on the opportunity to be getting better results and getting more out of the money that you have today. So what we've found is that there's actually 3 elements that you need to get right here: your structure, strategy, and solutions. Now, your structure is all about making it easy to save and making it easy to manage your money, but making it crystal clear exactly how much money you've got to work with when it comes to your saving, your investing, your debt strategy, or whatever the case may be. The next element is your strategy. And for the strategy, this is all about setting some, understanding the different pathways that are in front of you, the things that can take you from where you are today to the future outcomes that you want, and choosing the best pathway for you. And the third element is the solution. So what are the investments and the product solutions that you're using to back up your strategy? And here you want to make sure that you're getting reliable, consistent progress over time. And importantly, you're avoiding the chances of downsides and setbacks and those momentum killing mistakes. Now, what we've found is that the power of these three combined are much more than the three individually. And if any one of these three is missing, it ends up dragging down on the others. For example, if you've got a good structure in place and a good strategy, but you've got bad investments, you blow up your cash. Good structure, good investments, bad strategy or no strategy, leaving a heap of money on the table. Good investments, good strategy, no structure, working with the leaky bucket. It's actually pretty hard to have a good strategy if you aren't clear on how much money you've got to work with either. And so today we're focused in on investing. And that's the theme, but you should know that these elements are all important and are all things that you do really need to get right here. Another example for you guys, talking about replacing your income and how to actually do this. Now, my last book that I wrote, Replace Your Salary by Investing, I spent a lot of time thinking about what money success actually means. And what I came to is that everyone's lifestyle, the ideal lifestyle, is a little bit different. But ultimately, if you can replace your employment salary with investment income, that goes a long way to mean that you're now working out of choice as opposed to necessity, and means that you can then live your version of your ideal lifestyle. So I started looking at some numbers in terms of how we get there. And in Australia, the average income is $92,000 or thereabouts. Now, when it comes to money, we have this thing called the 5% rule, which basically says that if you've got a pool of investments, you should be able to draw an income of about 5% each year without eating into capital. That means that if you've got $1 million in a share portfolio, you should be able to get an income of about $50,000 every single year for the rest of your life. $2 million, it's an income of about $100,000 a year. And so to replace an income of $92,000, you'd need to have about $1.84 million. In terms of how much you need to save and invest in order to build an investment income of $92,000 a year, it depends on when you get started. So if you're 20 years old today, that you need to save and invest about $10.10 a day to get to $1.84 million by age 60. If you're 30 today, you need to save and invest $27 a day. At 40, it's $81 a day. And at 50, it's $296 a day. And so obviously you can see from these numbers that the sooner you get started, the less you need to do to end up in the same position. Now, $10 a day, that should be, it's not nothing, but it should be pretty achievable for most people. When you start getting up to $27 a day, that's getting trickier. We're talking about $210 a week, but probably still achievable if you really push. At $81 a day, you're talking about $560 of after-tax income a week that you're investing. And a lot of people don't earn that, let alone have the ability to save and invest that. And then at $50 a day, at $296, for age 50, $296 a day, that's like $2,000 a week that you're investing. It's going to be impossible for most people. So the sooner you start, the less you have to do to end up in the exact same position, which is why it's so important that regardless of how old that you are, that you start sooner, so that you need to do less later on. Got a question here that says, how do you know what is a good investment? And I'm going to cover that in the next section after this one. So I might just defer that until then. Now, in this section, I'm going to talk a bit about structure and making it easy to save. I recognize that your savings and cash flow is the least sexy part of your money strategy, but it's also the part that allows you to invest more money. So I'll just give you the quick version of this, but I want to talk about why it's important and how you could be thinking about this moving forward. Now, if we take a step back and think about your money, whether it's savings that you got in a bank account or your income moving forward, you've really only got two choices in terms of what you do with that money. You can allocate it to your spending today or your lifestyle today, and you can enjoy it now, or you can allocate it to your spending in the future. Now, when we talk about allocating money to the future, what we're talking about is your savings and investments. Now, in terms of what when you think about savings and investments, there's really only a handful of things that you can do. You can save money in the bank. You can pay down debt. You can buy shares or manage funds or ETFs. I put them all in the same bucket. You can buy a property. You can crank your super or retirement fund. Now, if you think about the first two, saving money in cash and paying down debt, they're two really important things to do. Things that smart, sensible, that you should be doing. They're also two things that are never going to get you rich. You're never going to get rich saving money in a bank account or paying down debt. If you want to get wealthy, if you want to build real wealth, you need to be investing into shares, into property, or through your super, or most likely some sort of combination. But with those three elements, that they are also invested in investment markets which go up and down over time. So if you want to choose good investments, to that previous question that we got, choosing good investments or making money investing is about two things. First, choose good investments. Second, never sell your good investments at a bad time. Because even if you've got really great investments in your portfolio, if you're forced to sell them at the wrong time, you can be selling them at a loss. And so we need to make sure that when you allocate money from the today side, from your income side and your saving side into the future side, that you're never forced to bring it back to the today side at a time that you weren't expecting. Because if you're never forced to sell investments at a bad time, then you can let your good investments do what good investments do over the long term, which is make you a whole bunch of money. Now, how you make sure that you're never forced to sell your investments at a bad time is you need to make sure that all of the spending that you want to do on the today side of things is provided for. Now, there's only so many types of expenses that people have. You've got your fixed costs, that's your rent bills, the boring stuff. Your spending, that's your walking around money. We've got your debt, everyone's least favorite category, but an important one to nail. Lifestyle, that's your travel fund and new stuff for the house. And so I'm not a big fan of the B word, but if you think about setting up a budget, the first step is going, okay, well, how much do I want to be spending in these different categories? And what does that mean for how much money I've got left over for savings and investments? And am I happy with that balance? If you're not, then you need to change some things around. And that's about prioritizing. And then once you're happy with the savings and investing plan, then you need a system that's going to back it up, because a good plan on its own is not going to get you good results. You need to make it easy for the plan to actually work. And so I'm a big fan of the bucket system of banking, where you've got different bank accounts for different buckets of money, so you've got the right money in the right places at the right time. This is how I run my own bank accounts. This is how we do it with our clients at Pivot Wealth as well. And it has the benefit of automating your savings success, making it really clear, making sure you've got the money for the things that you need when you need it. But also when it comes to your planning, if you're planning out how to replace your income, your salary income with investment income, then it tells you exactly how much money you've got and gives you a lot of confidence with the decisions that you're taking. So like I said at the start, I get that this is not sexy. There's not a lot of people who get super excited about this stuff, other than, the advisors in our team, but it is really the foundation for your investing and what comes next. Got a couple of questions here. I'm going to get into investing basics in a sec. Got a couple of questions here. Any tips for folks who are already over 40 and starting late? Look, the best time to start was always 10 years ago. The second best time is right now. So I would say start now, and be clear on your numbers as well. I think this is important for anyone, but particularly as if you're a little bit older, you want to be clear. If you keep doing exactly what you're doing today, how is your savings, investments, and your wealth position? How is that likely to progress, a year from now, 5 years from now, 10 years from now? Because if you need to change something, now is the easiest time to change it. If you wait 5 years and try and change something down the track, you're going to have to change a lot more. Another question, got a lump sum to either pay down debt, mortgage, or invest. My mortgage rate is 6%. Should I put the mortgage in my redraw or invest in the share market? Great question. And look, I can't give you advice without jumping through all the hoops from a compliance perspective. But I'm happy to share my thoughts in how you would think about a question like this. There is an answer from a numbers perspective, in that your mortgage interest rate is 6%. The long-term return on the share market is about 9.8%. And so investing in the share market is likely to deliver you a slightly higher return than paying down your mortgage. That being said, paying down your mortgage gives you a guaranteed return of 6%. So there's some merit in having that guarantee and that certainty. And the other thing that I would say that is, if you're a first home buyer, and you've just pushed yourself to buy your first property and your mortgage is really high and your surplus cash flow or your savings capacity is really low, then it may be more valuable from a peace of mind and a risk management perspective for you to actually pay down some of your debt. Whereas if you've had your property for a bunch of time and the mortgage is at a comfortable level and your cash flow is reasonably strong, then you may be more inclined to invest rather than pay down the debt as well. So I hope that helps. That's how I would think about it. Michaela says, how would you structure this if you're a business owner and income varies each month, a certain percentage? That's a really great question. How I would do it is to just put a buffer into the top account. That's how I've done it. That's how we do it for our self-employed clients, because if you know that your income over the year is going to be 100 grand, and you're allocating your transfers between these accounts based on that, then if you put it, say 100 grand in this account, which is obviously, you wouldn't do that, and then that's more than you would need. But in theory, if you did that, there's enough money here to cover all the transfers. And then when you make your 100 grand over the year, that 100 grand gets replenished and your system never ever breaks. So there's probably a number somewhere between $0 and 100 grand, which is the right buffer to put in here. And if you do that, that's what we call floating your accounts, makes it automated. It's an absolute game changer for business owners, self-employed people, and freelancers, because otherwise you're just stuck in this constant juggle. Good question here. Which platform do you guys recommend? CMC, Perler, etc. We recommend a lot of different platforms, and I'll talk through in the next section exactly how you can choose here as well. Does automation of investing potentially cause shares to be bought at a wrong time at a high, meaning we are downsides to automation? Look, it's an interesting perspective. I think that we never know when markets are at a high until after the high has passed. Like we never know when markets are at a downturn until the downturn has passed as well. And so Perla, who are our partners for this event, they found some really interesting statistics on investing in a downturn, which found that basically if you invested 10 grand into the share market over a 30-year period, it would grow to be worth about $208,000. If you'd missed out on investing on the 30 best days in investment markets over that time period, it would be worth something like 40 grand instead of $208,000. The really interesting part of this data, though, was that the half of the best days happened in a bear market, which is where the share market goes down by 20% or more. Another half of the remaining half, so 25% of the total, happened immediately after a downturn as the markets recovered. And then 25% happen on the way up. And so that says that 75% of the best days in investment markets happen either during a downturn or immediately after a downturn. And so if you're sitting on the sideline saying, I don't want to automate when the markets are at a high, you're going to miss out on the best days in markets and your returns will seriously suffer. So for me, I invest every single week. I invest every single week, week on week on week. And I know that sometimes I'll invest at a high, but sometimes I'll also invest at a low. And if there is a serious correction in markets, I've got money that I can invest more to accelerate things and pick up more on the upside as well. Guys, I'm loving these questions. Keep those coming through. I am just going to crack into the next section just to make sure that I don't talk too much and I get through this content, because there is still a little bit there. So investing basics. I'm going to start from the super start on this. I might just get through this example, actually. I'll start from the super basics, so please do bear with me. Look, I think that to just sort of wind this in, that I think a lot of people know what you need to do to make money investing. You need to find a few bucks to invest. You need to invest and choose good investments. And we know that index funds perform best more than 80% of the time. But a lot of people don't get the results that they could because they just don't get started. And so I hope you guys get some great ideas out of what we're about to cover. But know that the power of an idea is in its implementation. And if you don't do anything, then nothing is going to change. The fear that comes with investing or making any sort of money move, it is real, but it does lead to inaction and ultimately missing out on opportunities. And so you need to push through that. Otherwise, you're never going to be able to play a bigger game. So into investment basics. Look, I'm just going to start with the super basics here, talking about the difference between defensive investments and growth investments. There are basically two types of investments here. Defensive investments are things like cash, cash savings accounts, where they're called defensive because they're less likely to go backwards. With cash accounts in Australia, cash accounts are government guaranteed up to a certain level. You know that the money's going to be there, essentially. Fixed interest, that's things like a term deposit where you lock up your money for a period of time and you get a slightly higher return, but there's also a little bit of risk, a little bit of extra risk because your money is locked up. In the context of investment funds and ETFs and that sort of stuff, fixed interest is like corporate bonds where you've got, you're lending money to, say, Commonwealth Bank or some big companies so that they can basically use it to fund their operations, essentially. And so it comes with a little bit more risk, but you also get a little bit more reward. So those are defensive investments. Then on the growth side, you've got property, Australian shares, and international shares. Now, with these sorts of investments, they are designed to grow. You buy a property, a share, an Australian share, an international share for a value today, then you'd expect it to grow into the future. In 10 years' time, if it's a good investment, it's going to be worth more than it is today. And so your split between defensive investments and growth investments is one of the biggest drivers of the results that you get over time. Now, my take on this stuff is when you're investing money that you want to grow for the future, you probably want to be more focused on growth type investments. If you've got money that you need in the short term, i.e. you're saving money for the kids' school fees that are due in 6 months or for buying a new car next February, you want them to be more in defensive investments rather than growth, because if you invest in the share market and the share market tanks, your money is at risk. And so understanding that split is important. It ties in with your investment timeline. Now, they say that for growth investments like shares and property, the suggested investment time frame is 7 to 10 years or more. The reason that they say that is because if there is a serious market correction and the share market goes way down, then it's possible that it could go down and stay down for 7 to 10 years. Now, it doesn't mean, though, that when you buy shares that you need to sell them, you need to keep them for 7 to 10 years. If you're investing money today, and as you can see from the little picture here, that if the share market shoots up and you want to sell because you want to use the money as a property deposit to get into the property market or buy next property or whatever, no issues there in doing that, even if you've only been invested for a day or a month or 6 months or whatever. It's just that any money that you do invest into shares or ETFs, you want to have the ability to leave there if the markets tank. Now, my take on how to structure the split between growth investments and defensive investments in relation to your timeline is that when you're investing, invest for growth. When you're, and this is not advice, and you should go and seek that out, as I said at the start, I like holding cash for short-term expenses and emergencies so that I know that I've got a cash buffer. Personally, I don't love bonds where you get a 1% extra return, but your sort of money's at risk, because there have been quite a few issues with bonds over the last couple of years in particular coming through COVID. For me, it just doesn't add up, but that's probably a whole nother webinar on that. But then if you've got your cash buffer for your emergencies and you know that all of your upcoming expenses are covered as per your cash flow or savings plan, and then you've got an emergency fund on top, then you know that money that you invest, you should be able to leave there for the long term. In terms of how to split this up between Australian shares and international shares, I believe that both are important. I think Australian shares are important because we spend Australian dollars. But I also recognize that Australia is a very small part of global investment markets. And so having some exposure to international markets will drive more returns over time. And to say it a different way, not having exposure to global markets, particularly US share markets, over the last little while would have been cost you a lot in terms of your returns overall. Lisa asks, would investing in the S&P 500 be considered defensive or growth? It would be growth because it's investing into shares, Alyssa. But I'll talk about the different types of risk actually on the next slide. Another question from Ben, where does crypto sit in the investment mix? That's more on the growth side for sure. But it's probably more on the speculative investments in that, potential to shoot the lights out, also the potential to go bust as well. Hope that helps, Ben. I like crypto. I've got some crypto myself. It's kicking ass at the moment, which I'm absolutely loving. But it's a small part, and it's where I see a lot of people go wrong with crypto is that they go all in on crypto early and they don't have a good foundation for their investments, and that can be great when the markets are going up, but it's very, very painful when the markets are going down. Ainsley says, how do we know which investments are the best and the safest? That's a great question, Ainsley. I am getting there. So good nudge into this piece, which is about different types of risk when it comes to investments. Now, in this example, I've got company one, which you can think about as a big, solid blue chip company. Think like Commonwealth Bank. Commonwealth Bank, one of the biggest companies in Australia. It's been around for a long time. It's got a lot of different income streams, got a really diversified operations, got really extensive management team and experience and all of these things in place that mean it's still a company. So it's going to be subject to the highs and lows of the share market, but you're going to get more stable returns over time. Now, company two in this example, you can think about this like a tech startup or a mining exploration company or something like that. You see that the share growth on that company is a lot more up and down. And the reason that it is because it's got fewer assets behind it. It's a much smaller company. If things start going well, then they start going really well, and it looks like the company's got huge potential. If things start going bad, then it looks really bad, and easy for companies to go out of business, and so the values get punished. Now, a lot of people think, to Ainsley's question, which risk is right? A lot of people think that when you start putting all of your money into, say, like a high growth investment portfolio or a high growth ETF, they start thinking that you start getting a lot of this speculative small company risk in your portfolio, but it doesn't need to mean that. So when I say if you're investing for growth, you want to be invested into growth shares, then what I mean is that you're investing into premium blue chip companies like Company One, where you've got stable returns over time. It doesn't mean that you're speculating into startups that may shoot the lights out, but where your money may also go completely bust, essentially. And so there is a difference. And so I forget who asked that question, but about the S&P 500 and an index fund, I would think of that as a more stable premium risk rather than putting it all into Bitcoin, for example, or all into a startup company, in smaller companies as well. Now, higher returns mean higher risk. And so when you think about speculating, and we've all been there, because our inner investor really, you see this stock, it's been pumped. It's 10 cents now. It could go to $1. I'm going to get a 10x return. It's going to be awesome. But you see from some of the examples that I've shared with you already that you don't need to shoot the lights out to get some pretty crazy results over time, just based on the long-term share market return. And so, I think that, particularly when you're in the early days of your investing, that avoiding speculative investments as much as possible and building the right foundation serves you really well. Once that foundation is built, if you're particularly interested in more speculative investments, I would say that you really want to pursue it, then obviously you can, it's your money, but you want to try and limit your exposure to those sorts of investments so that it's not stressing out and can't sleep at night. Now, diversification is a really effective, in fact, one of the most effective ways to manage risk when you invest. In this example, I've got Company One and Company Two, which is two big premium blue chip companies. You see that they're different. Think of it like Commonwealth Bank and Woolworths. So two great premium, blue chip just means premium, means big, stable company. If I was to get $10,000 and put half into CBA and half into Woolworths, the return that I would get would be the average of the return on each of the investments. So you see that return line is smoother over time. Now that's with two investments. If I was to put 20, 200, 2,000 into a portfolio, like what you get in an ETF or a managed fund or one of these investment apps, that you're getting one investment option, which gives you instant diversification and means that your return is a lot smoother over time. And so it's a really powerful way to invest, and invest in a way that you're not putting all of your eggs in one basket. The more diversified you are, the more diversified you are, if there is any issues with any one investment in your portfolio, say one goes bust, it's only a very small part of your overall portfolio that's at risk. And so even though it's very, very unlikely that the big companies really go completely bust, it is possible. And so reducing that risk is a powerful thing to do. Now, I want to talk about the market and index funds and active and non-index funds and how they work. And so what I've got here, I've got the ASX 200. Now, the ASX 200, ASX is Australian Stock Exchange. 200 means the 200 largest companies on the Australian Stock Exchange. So if you see the news at night and they're talking in the finance section, oh, the ASX is up by 1% or down by 1%, what they mean is that the combined value of all of the companies that are listed on the stock exchange are up or down by that amount. Now, we know what those companies are. It's all publicly available information. Now, at the time, this is a little bit outdated now, but at the time that I pulled this, CommBank, biggest company in the country, $199 billion. And the combined value of all 200 companies was $1.67 trillion. So at $199 billion, a Commonwealth Bank accounted for 9% of the Australian share market. Then we got the big banks, Woolworths, Wesfarmers, etc. We know what those relative proportions are. Now, what an index fund does is it just gets a whole bunch of investors' money, or an index ETF, and it just invest the money in exactly the same percentages as the market overall. And so what that means is that the return on an index fund is exactly the same as the return on the overall share market. Now, the 30-year return on the Australian share market is 9.8% a year. That is the return that I've used to put into that calculation around, saving and investing $10 a day gets you to $1.8 million by age 60. So the return is really strong. Also, with an index fund, it is investing a little bit into every single company. And so the only way that the value of an index fund can go all the way to zero is if every single company in the country goes bust at exactly the same time. So think all of the banks collapse, Woolworths, Wesfarmers, so Coles and Woolies are gone, Telstra's gone, we've got no phones, no internet. The mining companies are gone. You can see that if that happens, honestly, we have much bigger problems than the value of your investment portfolio. We're talking about the end of life as we know it, like a nuclear winter type situation. And so the risk of it going to zero is very low. Also, when the value of an index fund goes down, I think one of the biggest benefits is that because I don't like to say you're betting when you're investing, but essentially what you're backing is that good companies will continue to make good money. So we know there will be times where the whole share market will go down on balance, but we know that over the long term, companies recover. And so it's simply a matter of time. That contrasts to, I'm just going to jump around for a bit, for an actively managed fund, where with an actively managed fund, you've got some fund manager or research house or computer algorithm or proprietary formula where they're saying, we think that these companies are going to perform best. So we're going to put more money in them and we're going to put less money in some others. And then we're going to outperform the market, basically. Now, with an active fund, they sell it on the potential for outperformance. Because if you're choosing differently to the market, then you can perform better than the market. They are generally quite well diversified, although then they're often not as diversified as an index fund. And they can be good at retirement as well. Like if you're getting close to retirement or living on your money and you want to invest in different ways to manage your risk differently or drive income, then actively managed funds can be good. But outside of that, the stats tell us that index funds perform better than active funds more than 82% of the time. And so what that means is if you're investing in anything other than an index fund, more than 8 out of 10 times, you're going to be behind. You're not going to be as well off as if you just invested with an index fund. It essentially gives you the investing cheat code to tell you exactly where to invest money so that you're always at the best performing investments. At the end of the day, I appreciate that there's a lot of different ways to be right when it comes to investing, but the stats show us here that this performs quite well. Index funds are low cost, they could consistently perform better. They give you more confidence to invest more. They give you more confidence when markets are down. And it means that you don't make reactive decisions where you end up losing a bunch of money. And so for that reason, that's why I personally use index funds. It's why we use them a lot with our clients as well. Now I'm going to get into the types of investments and practically how you can do this, but I'm just cracking with a few questions. Loving these questions, guys, as well. Should I be investing my monthly investment money once a month, or split and invest each week? Look, I like weekly, but it depends on how much you're investing and whether you're paying fees on that as well. So yeah, so it really does depend on that. You just want to make sure that the fixed cost that you're paying is not high. But if you've got a low cost one, I would prefer more frequent than less frequent, because within the month can be quite variable in terms of what happens with markets, and you do get a smoother return when you do it more frequently. When would you suggest engaging a financial advisor? I engage a financial advisor with 10 grand to invest, or build up an investment portfolio of 10 grand first. Look, I think if you've got money and you know that you want to invest it, you may not need a financial advisor. Probably a webinar or two, or maybe a book, maybe a great book called Virgin Millionaire might be enough to get you there. Where you want to use a financial advisor is where they can add more value than the fees that they're going to charge. And so often that's not about just saying, just go and buy an index fund. It's about optimizing your situation from a tax perspective, looking at what you're doing with your property strategy, your personal investment strategy, your superannuation, and all the rest of it. So that would be the main one. But if you're thinking about it, I would say have a chat with a financial advisor. They're generally going to be pretty happy to talk to you. And then they can get a bit more specific in terms of whether it's right for you, or whether they think it might be right for you, and how you should be thinking about it. Vero. Hi, Vero. Vero says, investing in the S&P 500 now a good idea given the current politics in the US and Warren Buffett converting portfolio probably a tiny portion into cash? Should I just focus on the ASX 300 now? I appreciate your general perspectives. Look, I think the share market is a bit hot in America, but also Trump is a wild card, and I think it really could go either way. And I don't have a crystal ball. I wish that I did. I would have more money than I do right now. But I think that trying to pick which way it's going to go is really tricky. I think if you are investing for the long term, then time de-risks all risk. And so I see a lot of people that they stop investing, and then you're sort of agonizing on when do you change your strategy and when do you change your tactics. Instead, you want to try and set your strategy first, look at what's happening, make sure that the pathway forward actually works for you, and then just consistently follow it through. So from my perspective, I'm still investing in the US just as much before. And, those, particularly the big tech companies that they just keep going and going and going. And so I don't want to end up behind, missing out on that, which is part of the reason that I personally do it. At the end of the day, though, if you're stressing out about it, then it probably isn't the right move for you. Is there an ETF that exposes you to fund managers who invest in startup companies that have the potential to become unicorns? Good question. I'm not familiar. I don't use one myself, but I don't know that there's an ETF that typically those startup companies are unlisted investments. Most ETFs will be invested into shares that are listed on the stock exchange because of the nature of how ETFs actually work from a practical, technical perspective. But it sounds like an interesting idea if you want to have it's definitely a speculative investment, but if you find one, let us know. All right, I'll push on. Keep those questions coming in, and then I'll crack through this, and then we'll jump into questions from there. So guys, types of investments that we've got shares, managed funds, ETFs, and micro investing apps. Now, at the end of the day, shares is where you're buying a tiny little slice of one company, and really all investing apps, ETFs, managed funds, they're all based around shares. Shares are great because they give you a slice of a company, meaning that you benefit from the growth of that company. But they are they lack diversification, because when you buy a share, you're just buying literally one company. And so it's hard to be really diversified. Even if you had $100,000, even $1 million, you're going to have either a really complicated portfolio, or you're going to have a small number of companies, and it isn't going to be very diversified. The rest of the options that I'm going to talk about, managed funds, ETFs, and investing apps, they're all based on investing into shares, but they're all done in a pool way, which means that you invest in one managed fund or one ETF or one investing app, and then it in turn is investing into a whole bunch of different underlying investments. Now, they are all slightly different versions of the same thing. Managed funds are like a pooled tax structure, whereas with ETFs, you own a tiny little slice of a whole bunch of shares, meaning that you have a little bit more control from a tax perspective. With micro investing, it means that you can invest fixed dollar amounts. So like you can invest starting from as little as 1 single cent. Most platforms allow you to invest starting from $5. Fees are lower, meaning that there's no brokerage cost. So there's no, a brokerage cost is like a fixed cost for buying an ETF. That doesn't exist in the micro investing space. And so it can be great, particularly as you're getting started investing, to crank it out that way. Now, there's also a bunch of child-specific accounts out there if you're looking at investing for your kids. So Pearl, Head Start, Raise Kids, Spriggy, which you can use as an education tool, similar versions of the same. What I will say is that if you're investing, you've got less than 200 grand in investments, the difference between a managed fund, an ETF, and an investing app is going to be very, very small. I just looked at it on $100,000 for an Australian share index option, and it was basically like $60 difference over the course of a year. And the reason that I put this slide in is because I find that a lot of people, when they're looking at this investing, that they're agonizing over, oh, should I do ETFs, or should I use the app, or should I use managed fund? At the end of the day, they're all pretty much the same. And so instead of trying to figure out the best one, which you're never going to know anyway until after the fact, you focus on a solution that's easy, because then you can get started sooner. Getting started is better than getting it perfect, because you start building momentum. I see a lot of people that end up stuck on the fence for ages, and they've missed out on investing all this money simply because they didn't know whether an ETF was better than an investing app, or the vice versa. Not a good outcome. I'll crack through with tax, because when it comes to tax, tax is the biggest opportunity and biggest potential roadblock over time. If you're trying to replace your salary with investment income, that means that you, by definition, you're going to be building an investment income of like $50,000 a year, $100,000 a year, maybe even more than that. And if you're not smart about how you run the tax and how you plan around the tax, you're going to pay a lot more tax, and that means it's going to take you a lot longer to get there. Now, when you invest, the after-tax return is the only return that matters. You only get one tax rate though. And so this confuses a lot of people, that you get one tax rate where at the end of the year, you report into the ATO all of your income from your work, which your employer does, and then your interest income from bank accounts, your dividend income from shares or your investment apps, any rental income from investment properties, commission, bonus, overtime, capital gains, whatever the case may be. And basically all of that number is added up to give you one combined number for your assessable income, which is taxed at your marginal tax rate. You don't get taxed at a different rate for share dividends versus capital gains versus anything like that. It's one tax rate that applies. But the tax rates are different for different entities. And when you invest, you don't need to own your investments. You can own them in the partner's name, jointly with your partner, under an investment bond, under a trust, under a company, and they all have different tax rates that apply. Now, these are the personal marginal tax rates in Australia. So the first 20 grand you earn, roughly, you pay no tax. Then 20 to 45, you pay 18%. 45 to 135, 32%, 135 to 190, 39%. And then the top marginal tax rate kicks in from 190,000. That's 47% a year. Now, if you're earning 90,000 and you're trying to replace your income of 90,000, it's basically pushing you up into the top marginal tax rate. And if you've got higher goals, then you need to, you're going to be well into that tax rate. And so that's why it's so important that you're smart here. The different tax rates that apply for different entities, you can see, are a lot lower than personal marginal tax rates. Super has a maximum tax rate of 15%. Companies have a maximum tax rate of 30%. Bonds have a maximum tax rate of 30%. Way, way lower than it is for your personal marginal tax rates. And so I've got an example here showing investing through a company. So when you invest through a company, basically anyone can set up their own proprietary limited company. You go and get a tax file number, and then you can open a savings account, an investment account, and start investing. When you invest through a company, because the company tax rate is 30%, then that means all your future investing profits get taxed at 30%. So if you got 100 grand of investment income, if you earn it in your own name and it gets taxed at the top marginal tax rate, you're going to pay about 47,000 in tax. At 30%, you're going to pay $30,000 in tax, just to state the obvious. Now, that is $17,000 a year in more tax that you would pay, meaning that you've got $17,000 a year less to reinvest and grow your investments faster. This is why tax planning can be so powerful and is so important. And if your goals are bigger, the savings are bigger at $200,000, $34,000 a year in tax that you save, $30,000, $50,000 a year, et cetera, et cetera. So a lot of people come to us, they're talking about tax. We pay a lot of tax in Australia and everyone wants to cut their tax bill. And that makes a lot of sense. But at the end of the day, there's a limit to how many paper clips you can buy and how many deductions that you can get. And you need to, you're sort of almost playing at the edges. The bigger opportunity is being smart with how you're planning the tax around your investments. You pay less tax, you get ahead faster. So I'm going to skip through this example just in the interest of time. And I'll talk through a few myths and mistakes when it comes to investing. Then I'm going to crack into Q&A. Now, first one is that we don't have or earn enough money to invest. That's not true because micro investing starts at 1 cent, most of them $5. Everyone can afford to invest $5. So there's no barrier there. And doing anything, investing $5 a month even from a mindset perspective is a million times better than doing nothing. Choosing bad investments that will fail, that's a really common one. Basically, just buy a slice of the whole market. There, like I said, a lot of different ways to be right when it comes to investing. But if you're worried about choosing bad investments, buy an index fund, and 82.93% of the time, you're going to be better off. Income is variable. Consistency is impossible. You can create your own consistency using that saving system that I mentioned. Goals too far away, really big goals, all impossible and pointless. It's another one. And take action now and build your momentum. You're often surprised, like that example that I shared at the very start, how much of a difference taking action now will make into the future when you get started. And ultimately, yeah, doing less today means more sacrifice later on. Investing is complicated and confusing is another one. And I get it. It's investing is a knowledge area and a skill that you build over time. And so, there's a bit to it, but once you understand it, it's actually a lot simpler than most people think. You also follow a step-by-step guide and follow a proven system so that you can get success the smart way. All right, guys, so I'm going to jump into Q&A in a sec, but I hope you found that helpful. I want to share this final piece with you around getting from where you are today to future state when it comes to your money. Now, at the end of the day, in the future, you're going to be somewhere on the spectrum. Some of you are going to be absolutely crushing it. Some of you are going to be doing not so well at all. Now, a lot of people think when they think about getting from where they are today to future state, they think about their progression like a straight line. But because of the compounding impact of time and money, it's actually a curve. So for you right now today, if you're not 100% on track to end up exactly where you want to be with your money, you need to do some stuff and what we call jump the line. You need to start investing a bit more, saving, optimize your tax, sort out your super, whatever the things are. And once you do that, then you just need to take the next step and the next step and the next step, which is easier because you're already on the path. But the longer you leave it, the more that goes on, that jumping the line becomes more and more painful, and putting yourself in the best position possible can become impossible. No matter where you want to get to, the sooner you start, the easier it is. And the longer you wait, the more you have to sacrifice. That's essentially how it works. So like I said to you guys at the start, I hope you're going to get some great ideas out of what we've covered today. But at the end of the day, know that information, I've got this quote here from Derek Sivers, says if information was the answer, we'd all be billionaires with perfect abs. And it's so true. It says that if you want results, you need to take action. Like I said at the start, less than 10% of New Year's resolutions are achieved. And I think if we're being honest, then it's probably, the number is probably a lot higher than that. And so your action from here, your action is key. So you want to lock in yours now. Make a date with yourself if you need to set up your investment plan, go download the app and get it happening, do your budget, whatever the things are for you, make it happen. And then you keep your momentum building. Now, guys, this is what we do at Pivot Wealth. It's how we help people as well. And so if we can help, then we're very happy to chat. We do this 10-minute intro discussion where we basically cover, give you a bit of no BS Q&A, help you understand what your next steps are, and can help you start the new year ahead. If you want to check that out, you can just go to bit.ly/Perla Pivot Chat. I'm just typing this out so I can put it into the chat box for you guys. Stand by. You can also use the Q&A there as well. I cannot figure out how to do that, but stand by and I will pop that into the chat in a second. My tech struggles today. Great. If someone could just let me know that that's working okay as well. So if you have some Zoom issues ongoing as well, that would be great. Awesome, guys. So I'm going to crack into these questions. Sorry. And last thing, if you enjoyed this, we've got a bunch of events and content coming up. So give us a follow and get around that as well. We've got one for early in the new year if you want to start your new year strong. So feel free to check that out. It'd be great to see you there as well. I'll leave that link up there just so I cut through any questions. Okay, so where is a good place to put one's emergency fund? Around 30K, since cash is not great inflation-wise. A bond's a good idea. Look, this is not advice, but my take on this is that bonds are not great. And I think when you've got cash in an emergency fund, even though it is going backwards after inflation and taxes, it's doing a really important job, which is giving you immediate access to cash if you need cash in the event of an emergency. And so I would say that in that case, it's worth paying a bit of a price, in my opinion, to have the money readily available. I got my emergency fund in cash. I would be reluctant to put it anywhere other than a cash account so that I know that there's immediate access to that money. What about US and Australia? I feel like we've covered that. Shares or super for the best return? Great question. The investments are essentially the same. Super, therefore, will give you a better return. If you've got an Australian share index fund in your personal name, an Australian share index fund in your super fund, the super fund will give you a better return because your tax rate is lower in your super fund. But there's, essentially you can get the same investments in your super that you can get outside of super as well. Guys, I'm happy to go a couple of minutes over and answer some more questions. I appreciate all the thank yous coming through, guys. You got this. New Year's around the corner. Make 2025 the year that you knock it out of the park. Feel free to stick around and answer these questions, but I know that some people got to probably jump to the next Zoom fun session as well. Cool, guys. I appreciate all those comments as well. Thank you, guys. You're very welcome. All right. So Freya says, how do you decide how to structure, i.e. investing as an individual versus setting up a company or a trust to own an investment? How you will want some things that I think are important to look at there. Firstly, understanding the benefit that you're going to get from using any tax structure, whether it's a bond, a trust, or a company. You want to know what is the benefit that you're going to get and what are the costs that you're going to pay. And so you want to make sure that the benefits that you're going to get are going to be more than the cost, both now and into the future. That's an important part. Also, try to avoid a bit of the conflicts of interest. If you talk to your accountant, they may be more inclined. You may have a really great accountant, but sometimes we've found that accountants are a little bit more inclined to recommend these structures because they get paid for setting them up as well. Offset versus shares, I think we covered. If you have made some money from property, is it wise to move that money into shares and start generating income now rather than waiting? generally, but I would say that if you think about doing something like that, it's worth getting a good financial plan because it will make you much more money than it costs you, mean that you're confident to do that. And if you're investing big chunks of money, you probably want to have that peace of mind as well. How much do we need to hold for an emergency? Any percentage of our expenses? I would say it depends on how you feel about that, but how much I would say a good starting point is 3 months of your bills. Three months of your bills and your basic stripped back living expenses is a good starting point. If you want 3 months of all of your expenses, then that's a better number. If you want 6 months or more, if you're self-employed or you're freelance, you might want that number to be a bit higher. If you work, I was just chatting to someone that was in media. It's a little bit more fickle in terms of job security, so they wanted to have a little bit more. So it really depends on you, but that should be a good starting point. Current mortgage is $1,000 per week, but loads of equity. Would you sell down and downsize to be mortgage free so you can divert the extra money into shares? Keep in mind, dream house and annualized growth around 20%, doesn't give any income. Yeah, look, it's important to find the balance between how much of your wealth you have in your home and how much wealth you have outside of your home. Because if you only own your home, then you're basically going to have to work forever. And so you want to make sure that you're in that sort of situation. You want to look at how much can you save and invest, and does that allow you to build up your wealth position to a level that you're going to need or want to live the lifestyle that you want in the future? If not, you might want to look to potentially adjust things a little bit. Even better, before you rush out and buy your dream home, you probably just want to understand the numbers and the impact more as well. Guys, I'm going to take one more question and wrap it up there. I really appreciate all those questions coming through, guys. So feel free to hit me up on socials or come along to the next event. I'll try and make sure that there's a bit more of a buffer for more questions. Kyra says, how do I assess if my investment portfolio is good? I automate to prefer and set and forget, but also want to make sure that I've selected the right ETFs and shares. However, the ROI looks different every day. How do I figure if my portfolio delivers results? I would be looking at what are the sorts of investments that you've got. If you know that if you've got an index fund in there, then your returns are going to be the market returns, and that's going to be the return that you want. If it's not an index fund, then you need to look more, how is it performing relative to how the market is performing? And it does get a bit more complicated, means that it takes a bit more time. You could get someone to look at it for you as well, but it is natural that every day is going to be a little bit different. That's just ultimately how investment markets work. Guys, thank you so much for all of the questions. I do really, really appreciate it. As I said, that there's a ton of other events and content that we've got coming up as well. And so please do get around that. Great to see so mmany of you guys stick around there as well, and appreciate again all of the thank yous coming through. We are going to send around the recording too, so check that out. Guys, and if you get stuck or you need help, you know where we live. Cheers, guys. Catch you next time. Bye for now.